There's been a lot of talk lately, and I mean the end of 2024, about an upcoming lost decade. Have you heard this? Have you been thinking about it? Today we're going to talk about it. What to do if 2025 through 2035 is a lost decade. And I want to bring in my co-host Tony Shore to talk to me about this. Welcome to the show, Tony Shore. How are you?
Oh, Dan, the lost decade. Wouldn't that be Japan? Didn't Japan have the lost decade? Wasn't that the whole thing?
So are you punishing me for letting you in on what we're going to talk about in advance? This is your homework? You come up with turning Japanese?
The Vapors turning Japanese
I would
on
never have
Dolphin
known
Financial Radio.
I don't know who sang that. The Vapors? You know what? I should have clarified the lost decade. You're right. The lost decade is associated with 1990s Japan.
Right. And that's why.
That's an 80s song, though. Right?
But Dan, speaking of Japan, there was an obscure Japanese alternative band that did a cover of the song Money, That's What I Want, made popular by the Beatles. But right? So we're going to play some Japanese music. And the lyrics have to do with
the best things in life for free.
I'm torturing you now.
You can give them to the birds and bees. I
know the song. That's what I want. Yeah, the Beatles did that. Oh my goodness, Tony, you're correct. Japan was the lost decade in the 90s, and some will say it's a 3-decade affair for them.
Mm-hmm.
But that's not what I'm talking about. I can't believe I should have clarified. You're right. You know what? I can't hold it against you because that's what the original lost decade was, when Japan roared to the top in the 80s. You remember that?
Yeah.
And then in the 90s, they didn't have any growth. I think they had 1% growth in all of the 90s, and on average, per year. And then I think that's continued through 2000 to 2010 to 2020. I think now Japan is probably on a 30-year slide here of no, but that's not what we're talking about. We're talking about.
But that was Japan. But wait, before you get into what we're talking about, for me, Dan, the lost decade was the 80s, because the 80s were really good to me. I was young, just out of high school, and got my first big 15 minutes of fame at the big top 40 radio station in Minneapolis. I was a DJ throughout the 80s, and that's the lost decade for me personally, is the 80s.
Newsflash, Tony.
Yeah.
LPs are no longer something that people listen to.
Yes, they are. In fact, they've come
40
back
years
strong.
ago. Your room is still looking like the 80s. No, we're talking about the lost decade that's going to happen. But the most recent lost decade was 2000. Speaking of your boy Prince from Minneapolis.
Yeah.
1999. At the end of 99, if you look at how the stock market performed, the S&P 500, for instance, from 2000 to the end of 2009, it was actually negative. The overall return, I think it was like a negative 5% or something.
Sure.
So if you think about, all right, I put my money in the market for that 10-year period, you lost. You didn't gain anything. That's the lost decade. And so what's happened in recently, Q4 2024, Goldman Sachs, their chief U.S. equity strategist, David Kostin, said he's suggesting that the U.S. stock market is heading for another lost decade, and that the S&P 500 will return about 3% a year for the next 10 years.
Wow.
Have you heard this yet?
You know what? I thought I saw a headline about it, like an opinion article, like Goldman Sachs says, we may be headed for the lost decade. I've seen.
And you went right to Japan, and you're like,
yeah. And I'm like, oh, Japan. But I mean, I was in high school in the 80s and heard my parents say, oh, the Japanese are taking over the world. And, Japan was the country that we had to beat. And, the U.S., it was like the U.S. versus Japan. Are they going to become the economic superpower? And, my parents were saying things like that. And if only I'd known what I know now, then I would have told them, well, I don't see that happening, because just they don't have the size. I mean, we have so many spenders, and really it's about how many consumers you can produce.
But it was about technology too, and they
It
were
was
advanced.
technology, yeah.
You think about the 90s, I mean, the 2000 lost decade for the US. You had the
Yeah.
dot-com crash. So
Yep.
the 90s were great,
Yeah,
for
for
the
the
stock market,
US, the 90s were
right? Then the
fantastic.
dot-com bubble burst in 2000,
Yep,
and then we had the global financial crisis in 08, 09.
yep.
So you had two huge decreases during that 10-year period. So that was a lost decade, and that was a lost decade for you and I, because we were earning and putting money into the market theoretically. Now the question is, if it happens again, what would we do differently? What should people do differently? So, but first, why? So why is Goldman Sachs saying this? And then they're not alone. There's some other big names out there
Yes.
saying, even when I talk to money managers all the time, because I have people's money in the market. And I talk to money managers. Hey, what are you thinking?
Yeah.
What's going on? They all are saying you got to taper your expectations. We're going to have 20% returns in 24. We had 20% returns in 23. They're like, don't get used to that. I think we're going to go back to normal, mid single digits returns.
Yeah, the senior portfolio manager, I was literally just on a trip, a brief 2-day trip, and I traveled with the senior portfolio manager for Gradient Investments saying the same thing.
Yeah. A lot of them are saying it, and granted, is that the thing to say, are we going to have a 2010, 2000 to 2010 where we lose? Goldman saying we're probably going to be down to 3, which isn't great for stocks.
Yeah.
The average is 10
That
to
seems
15%,
lower than
right? Double
one
digits
would
are
hope.
expected.
Yeah.
Right? If you're going to invest in the stock market, you're expecting 10, 12, 13% return on average. But they're saying because we've had such high growth recently, everything's overvalued, and that we should have a return to the normal. But also they're saying it's highly concentrated in the Magnificent Seven. All right, Tony, quick. What are the Magnificent Seven to the listeners that don't know who the
Google,
7 particular companies? Apple's one.
Apple, Google.
That's
Meta.
Alphabet. Meta is Facebook. Yep.
Yep.
That's 3.
Microsoft.
Microsoft's on there.
Is Nvidia on there?
Nvidia's on there. They're a biggie.
Yeah.
Who are we missing?
Amazon. Amazon. That's right. Amazon.
And
That's 6.
Your boy, Rocket Man, with his electric cars.
Is Tesla in the Magnificent Seven? Wow. Okay. So I know they've slipped a little bit recently, but yeah,
those companies represent a huge portion of the gain. So what Goldman and others are saying is, if those companies falter, then that sector, that technology, we can see major decreases in the stock market across.
Sure.
Especially if you're buying the S&P 500, which is not all equally weighted 500 stocks. It's based on market capitalization,
right?
Meaning the bigger companies, those Magnificent Seven, represent an outsized portion. So what they're saying is this high concentration in these 7 stocks, it's a high risk. So if those, and the point is, how long can they sustain such an amazing distance between them and player number 2? Is Google going to be the search engine always, or will some other new technology come along and move Google away, or whatever, however Google's making money, or Meta, or Nvidia, with their chips.
And they're all internet. What I see happening, Dan, I'm going to throw this out there. You can tell me what you think of this. So, because I lived through, those are my prime years, the 80s, into my young adulthood. The 80s and 90s were pretty steady. If you look from like 84, 85 on, we really had a long period of pretty good markets, pretty good economy, steady. And then 2000 hit, and from 2000 until 2010, problems. And you know what I see that happened is major changes to the way we do things. So the internet, we had a disruptor, and I believe it was technology related. It was the internet and the smartphone, but especially just the internet and computer chips getting better. Now, I think one reason why people are saying this, I read that AI is going to cause another lost decade because it's going to displace workers and make a major change in how people do things, right?
And so the big names won't necessarily be the big names because AI is going to bring something we're not familiar with yet. A new company.
Possibly. Yeah. Yeah.
Yeah.
And I mean, would you agree with that assessment that
Nope.
major change? No,
Nope.
you
I
don't think that
agree with
has
you at all.
anything to do
No,
with it?
actually, I don't know. I think you're right. I think that's the messaging is the AI.
Sure.
And I can see it. I could totally can. But I just don't know what's going to happen. I don't think anyone does. I mean, you think about the people that have been the
Well, yeah.
naysayers for years. You got someone like Kiyosaki. Whoa, is that his name? Good Dad, Rich Dad, Poor Dad. That guy.
Yes.
He's been saying, get out of the stock, buy gold, buy Bitcoin forever. Right.
And if you'd done what he said, you
would have
broke.
missed out on the 40% gains in the past 2 years.
Yeah.
So it's like, what you damned if you do, damned if you don't. But then they'll be right one day, like a broken record. Broken clock.
Even Jim Cramer's right once in a while, right?
And so then they're the next coming of Christ, right? So it's like,
yeah.
So my thought is, I don't know. I just simply don't know. And so when people ask me what to do about this, what do you think about the lost decade? I say it was not fun. But for people that were young and like myself in the 2000 and working, I'm adding to it. So it's going down. I'm buying dollar cost averaging. So I broke even faster than 10 years. But think about someone retiring in 2000.
If you're in retirement and you're in retirement,
story.
Yeah, that was a
so
tough
what
time.
should they be doing? How do they protect again? What if Goldman's right? What if we have 3% a year in the stock market for the next 10 years? And it's not going to be, you're getting 3% like a CD. It's going to be up 10, down 10, right? Up 12, down 15.
So you're not going to be able to do the old 4% rule where your retirement is just pulling 4% out of your stock accounts, out of your IRAs and 401ks. That's not going to work.
Right. You got it, but that's not going to work no matter what the stock market's doing. You can get away with it if the stock market's going up 20% a year. You get lucky, right?
Yeah.
Sequence of returns risk doesn't impact you because you had positive years. But what if we have some negative years, which is what everyone's suggesting is going to happen, right?
Right.
In the least, it's going to balance out to be paltry 3%. What if that happens? Right. So what do you do? Which way do you go? Do you then say, I'm out of the market? What about taking this? Because I said, the big factor is that it's overweight on these 7 stocks. What if you bought the S&P 500 equal weighted fund, meaning same amount of money in each of the 500 stocks? There's such a thing. It's called an equal weight S&P fund. You could buy that. Would that help? Well, it would diversify against the idea of having everything in 7 baskets, instead of 500, right? But there's a lot of talk about bonds. Not James Bond, but the bonds that you can buy.
Yeah.
Treasury notes, treasury bonds, why not lock in 4% and 4.5% on a treasury for 10 years, 30 years or whatever? Like all of a sudden bonds are starting to get sexy again because they give that steady coupon if you can hold it to maturity. And so people are like, oh yeah, maybe bonds are the way to go. What about dividend stocks? That's an interesting thought. Dividend stocks, right? So you buy the stock and let's say on average it's only going to go up 3%. Well, what why would I bother that? I can buy a CD for that. Well, you get the dividend, and if you reinvest that dividend, that adds to the growth compounding effect, so you get higher than the 3%.
Yeah.
A lot of people used to do that.
Yeah.
That's fallen out of favor, but now maybe it's time for that to come back. What about international? You talk to money managers in the past 5 years, they all laugh at international because it's out. U.S. has been the place to be for a while.
Right.
Any mention of international is like, what are you? All right, boomer. What? No. And it's so it's like, well, why not international now? If Goldman's suggesting there's a huge chance that the U.S. stocks are going to underperform, what's wrong with dabbling in international? Well, do I take it all and go to international? If international takes off, you'd be a genius, right? We've done shows on fixed rates. I'll put the up here for the viewers on YouTube. Why not take I had a client buy a 10-year fixed rate annuity, which is a MYGA, multi-year guarantee annuity, for 10 years, locked it in at 6%.
Wow. That's huge.
the conversation went something like, Dan, I want to lock in for 10 years, 6%. And I was like, oh my gosh, can you imagine locking in for 10 years? And he's like, can you imagine how awesome it's going to be when rates go down to 2 again? And I got 6 and everyone's like, where'd you get that? Where'd you get that CD?
Yeah.
I was like, I don't know. It was a conversation, but we laddered it. So, a little pool of money that he's not going to need for 10 years. That's not, what's wrong with that?
Yeah.
Starting to look.
Is there,
especially
how about that 10 years at 6%? Were there fees on that?
No, that's just a fixed rate annuity, but there's surrender charges. So if you want out early,
well,
you pay a fee.
you're
So
locked in for. There's
you're
no
locked in.
The liquidity is what
You
you
can
get.
get interest, but that's it.
Yeah.
But maybe and if you don't need it, maybe that's not a bad idea.
Yeah,
Well,
if you have
if
money
you
you're
told
not going to
me-
need for 10 years.
If you told me stocks are going to average 3%, then you'd be like, I can get double in a guarantee. All of a sudden, it's like, ooh.
Yeah.
Um,
But nobody has a crystal ball. We don't know what the market's going to do over the next 10 years.
Well, I do. I just don't tell anybody because it's illegal. I lose my license.
You do. Right.
The SEC would have me up against the wall.
You've got that special crystal ball.
I do have to shout out. So precious metals, gold has been doing great lately, right? And you see a lot of the TV ads. We did a show on, buying gold. Remember that show on the TV? Conservative talk radio ads. I got to give a shout out to one of my clients who actually inspired me to do this show. Scott, you're watching, I'm sure. He's a gold bug, but he said, hey, I've been seeing a lot of this lost decade stuff. What should I be doing? Should I be buying more gold? Should I, what do I do? And like I said it already, if you're young and you're just investing, just dollar cost average in the market over long term, you'll be fine. But what if I'm retiring soon? What then? So precious metals might be something to buy. What about real estate? What about, you could buy cheap beachfront property in Florida right now due to the storms. Is that worth it though? Energy is another option. A lot of people are, drill baby drill. What if Trump wins? Are we going to, is energy going to go up? It's already gone up lately. And then finally cryptocurrencies. And I just put these on there as alternatives to the stock market. Not saying that this is what you should do. Because again, like I said, Tony, I don't agree with you, not because I don't think your logic is sound. It's just because I don't know. If I did know, I wouldn't tell anyone. I'd be retired already.
Right.
So what do I suggest to people? All of the above. Diversify.
Yeah.
Ho hum. Boring. Yeah. Wah, wah, wah.
Surprise, surprise. A financial advisor says a fiduciary tells you not to have all your eggs in one basket.
Well, here's the deal, Tony. Telling people to diversify when the stock market in the US is raging 30-40%
is not a popular stance.
And your diversified portfolio is doing half of that. It's like, hey, guy, what's going on here? Everyone's doing well because they bought NVIDIA.
Yeah.
And you're lagging. You're still up, but you're lagging tremendously. Why am I listening to you and diversifying? It's times when the things turn the other way and that diversification comes in.
Well, the proof is in the pudding. We already had an example of why, and that was 2022. The market was down, bonds were down, the market was down. So if you had stocks and bonds,
right, even the bonds went down
20%, 15, 20, 20+%, your stocks were down, bonds were down and not worth as much. So, those people that bought the 4% fixed rate CDs or fixed annuities were like, everyone's like, what a fool in 21. You're like, the stock market, buy your 4%. And then 2022 comes along and they got their 4%. Yeah, at least it's money, and it's usually money will be there. You know what I mean? There's a big difference between putting money in the stock market and putting money in a MYGA or something like that, because you can get principal protection. So
that's what it's about. So there could be a lost decade coming, to conclude. There could be. I'm not saying there is. I'm not saying there isn't. But if there is, if it does happen, how would I recommend people protect? I wouldn't try and pick the next winner, because that doesn't work.
No,
you don't. You just It's like going to casino and, oh, look at black on the roulette wheel. Black came up 15 times in a row. I'm putting it all on red. No, it's the same odds every time. So why would you take that gamble? So you diversify. And then for those that are going to be retiring soon, you should already have an income plan in place. This shouldn't even be a question.
No,
You shouldn't be saying, all right, I'm retiring next year. Should I pull out of the stock market so I have some money set aside for retirement? That conversation should have already happened. And if it hasn't happened, you shouldn't be in a situation where the stock market determines whether or not you can retire, right? You should be in a situation where you're saying, if I'm retiring in 3 years, I'm going to take money out of the market now and put it somewhere so that in 3 years it's there for me.
but not
regardless
all
what
of the
market
money. But
Right.
you're not anti-market. The show isn't
No.
anti-market. I know you have your clients invested in the market, but in other things as well as they get closer to retirement. If you had a client who's 40, they might have everything in the market, right?
Correct. It depends on their timeline. So for
Yeah.
most of my clients are close to retirement, yet I still have tens of millions of dollars of client money in the stock market
Yes.
because I'm a believer in it, but I also have it in maybe income producing stocks or
Yeah.
bonds, or I have some off the table in CDs or fixed annuities. There's a lot of different ways you can go. The answer is not just pick one and hope. It's to
Right.
diversify
Right.
in the big picture.
Have a
and
plan.
then have the income ready to go at various stages of your life so that your lifestyle, your retirement dreams and activities aren't determined by who's elected president or what the stock market does or what the Federal Reserve does. That's not how you do it. Now, you might say, well, Dan, I don't have enough money to pull off retirement. I got to be in the market because I need that big growth. Now they're talking about getting 3%. That's not enough. What do I do to get my 8-10%? Different conversation. You might have to adjust your expectations.
Right.
You might have to go on the other side of the coin, which is reduce your expenses.
Sure.
But again, it's a tough conversation. But you'll never hear from me that diversification was a bad idea.
Right.
Because I don't play Monday morning quarterback.
Mm-hmm.
You just can't. You can't say I woulda, shoulda, coulda. I should have put it all in the NVIDIA.
Yeah.
No, that's not how you do it. But if you're starting to hear, and it's gonna get louder and louder, especially as we get closer to the end of the year. People are making their predictions for the future. It's going to get louder and louder. This drumbeat that the stock market's not going to be doing as well.
Right.
That's usually the time to go in the market because then it goes up, right?
Yeah. Yeah, it's crazy. Plus the election on top of it has people panicking,
Right. But don't forget the market has done tremendous the past few years. Like you can't forget that. You have this money now. What are you going to do with it? Maybe it's time to take some off the table.
Almost every presidential election year in the last 100 years, the market's been up that year. I mean,
almost every year in the last 100 years, the market's been up, regardless of what's happening. But could there be a lost decade? Yes. Would it stink? Yes. Because
it'd be tough for retirees.
It would be, especially for those saying they're 50 years old. I'm retiring in 10 years. That would stink to have a lost decade.
But for young people saving, putting money in,
shouldn't change your strategy.
It would be great, actually. You want the adjustments and the corrections because you want to buy low. And so when the market's only, down to only like 3%, then you're buying in at that. But if you're close to retirement, if you're within 5 years of retirement,
right?
Then you have to, 10 years from retirement, you should be working with a financial professional.
Yeah.
So if you're not, do that.
That's it. Yeah. And then, do you diversify even if you are younger? It's not going to, will it decrease your overall returns? Yeah, it might, but it might actually balance it out and let you grow in all different types of stock market environments.
Yeah.
It's truly an interesting conversation.
Sure.
What if these 7 stocks run into some sort of trouble?
Yeah.
Or what if 2 of them run into trouble and the S&P, the index fund you have drops just because 2 companies ran into trouble? That's not an unreasonable thing to happen.
No.
Why not diversify away from that? Totally legitimate thing to be considering now. So that's what I suggest people do.
Yep.
And that's it. Sorry, we didn't have a Japanese discussion, Tony. I know I kind of ruined your, but I appreciate the fact that you did some homework, you know?
Yes. There you go. Had to do something.
Well, thanks for a good show again. And, arigato gozaimasu? Konnichiwa? What do you say? How do you say goodbye?
Domo arigato.
I should know how to say. We'll just go.
Arigato.
Catch you next week, everybody.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.